Welcome once again to another edition of the Aussie Ideas Man. This one I'm going to try to knock out faster than anything else, which means you'll get poorer quality, particularly with me speaking. But nonetheless, what I'm doing here is a review of the review of Warren's Will Aptera Fail? Yes video. Now, of course, the one that reviewed Warren's Will Aptera Fail video is the cretin from Aptera Owners Club. I just love how silly he is most of the time. So let's just get stuck into it.
Hello, everyone. It's Steve with Aptera Owners Club, back from vacation. And during vacation, Drew from Tailosive reached out to me and asked me if I was going to make a response video to Warren Redlich's video. Now, I was unaware of Mr. Redlich, but then I quickly, did a search on YouTube for him and I found the video. Will Aptera fail? Yes. So I thought I definitely need to make a response video to that. Okay, so let's get started.
Hey, this is Warren Redlich. So many people are excited about the Aptera. This vehicle is supposedly going to be this great vehicle that's everyone's going to love. And I think it's going to fail. I'm going to explain to you why. I'm going to dive in. Lots of people excited. I think they're all wrong. I'm going to go out on a limb here and say Aptera is going to fail. I don't think this is a big thing, but I'm going to dive in and show you all the reasons why. Are you ready? Let's go. Let's just start off with talking about what Aptera offers. They've got a 250-mile range version that's $25,900. The 400-mile range version is the launch edition. That one is about $30,000. You can reserve it for $100 today. It ends up being $33,200 when you add everything up. I'm not sure what else was it to be added up. That's the launch edition, so there's some other things that are included. You can buy a 600-mile range version for $34,600 and a 1,000-mile range for $44,900. Whether these ranges are accurate or not, of course, is an open question. I can't say for sure that these ranges are accurate, but this is, they're not even in production, not even close to production. But let's assume these numbers are accurate, which is a stretch. So the one positive thing I'll say about Aptera right now is they just got a grant. This is in March. This is like 2 weeks ago. They were awarded a $21 million grant for solar mobility manufacturing. This to me says that the California Energy Commission is not very discriminating, not very thoughtful, and this is why governments shouldn't be involved in business. Is the government giving money to this? This is going to fail. I'm saying this right now, this business is going to fail. Did the California Energy Commission take a look at the likely business prospects of Aptera Motors before giving them $21 million for manufacturing?
Of course they did. That there is a due process for that. And if he looked at it, he would know that there were over 50 applicants and, less than 10% of them got a grant. So it's not like they're throwing money at everyone.
My comments with regard to that is governments don't know what they're doing when they check out new businesses. Just because they did due diligence doesn't mean that it was done correctly. Time will tell.
But this $21 million will help Aptera continue to carry itself along. I haven't seen anything about Aptera.
So I'm wondering why he's making a comment on why Aptera will fail, having never seen any presentations from Steve Fambro or Chris Anthony. I mean, there's plenty out there.
It's because he looked at particular documents which he shows and goes through and explains, and on the strength of those documents, he thinks it will fail. There is no need to go the extra mile and look at the vehicle. I've done that, and I realised that if he went and did that, he would probably have a lot more reasons to think it would fail. But there's enough just on the financial side.
So it's not like it's hard to find presentations from them.
To suggest that I think they're deliberately fraudulent. I've just seen enough to say this business doesn't have much of a chance of succeeding. So just for starters, here's one of the things that stood out to me when I looked over Aptera. If you look at their website, they have a menu, and the first two items on the menu are investment options. There's home, but then there's invest and accelerate. Accelerate is a way of accelerating how quickly you get your Aptera by investing in the company. Then reserve a vehicle is the third choice, and the details about the vehicle the fourth choice. This company survives by getting people to continue investing in the company. They don't.
That is true for every startup. They don't survive by selling products because they don't have a product yet. That's what startups do. I don't think that that's anything specific to Aptera, but you could say that for any startup.
The difference with Aptera is that they are heavily reliant on crowdfunding, whereas just about all startups rely on venture capitalists. There's a huge difference.
Don't survive by generating revenue. They survive by persuading, but I would say people who aren't very sophisticated investors to invest money in this business that has nearly zero chance of success for a variety of reasons.
I mean, that's also the case for Tesla. Tesla did not generate revenue for many, many years.
But
there is no point comparing. If you're going to compare, the nearest thing you can compare with is Aptera version 1, and it failed.
If you were pushing your company, you would think you would push the product first, you would push the business model first. Instead, they're pushing the investing because that's how they survive. Right here, it got this, what I felt was a misleading bit here. Each vehicle can generate enough solar power for 40 plus miles a day of free daily driving. And with the battery topped off from solar charging, you can travel up to 1,000 miles on a single charge. And there we get here. The average American drives less than 30 miles per day. So most Aptera owners will never have to plug their vehicle into charge. No. Okay, so the average American drives less than 30 miles a day. That's probably roughly true. But the average American also goes on trips that are longer than 30 miles. Like, it's an average of 30 miles a day. I don't know whether they mean the average American drives an average of 30 miles a day or the average American never drives more than 30 miles. I think we can all agree that people sometimes drive more than 30 miles in a day. Pretty common, actually, that, once a week, once a month, somebody's going to go on more than a 30-mile trip. And if somebody goes on a particularly long trip, if they get the 250-mile range version of the vehicle, it's likely that they're going to have to charge somewhere on the way. If you go on a 1,000-mile trip, even if you get the 1,000-mile range vehicle, you're going to need to charge on the way. And, will the solar power really generate 40 miles of driving? That's an open question. That would be at least 4 kilowatt hours. If they claim they're doing 10 miles a kilowatt hour, which is another stretch, and we can dive into that, and maybe we'll get into that at some point. But even if they were able to generate 10 miles a kilowatt hour, you would need to generate 4 kilowatt hours from your batteries, from your solar panels on the vehicle. And I think it's unlikely that they're going to generate that much.
That's highly likely that they're generating that much. They have a over 700 watt panel, and that's per hours. And then you look at how many solar hours there are in a day. I mean, if you have 10 solar hours, that's 7 kilowatt hours. Now, of course, that's not peak. That's peak power, and it's over. The 10 hours, you're not going to have peak power the whole time. And most days in the summer are going to be more than 10 hours. But they've done the math. You can get up to 40 miles. It's not like everyone's going to get 40 miles. And I will agree with him that this, like saying that most Aptera owners will never have to plug in their vehicle. That's depends on what they mean by most. By most, do they mean 51%? Yeah, probably. Yeah, I think more than half of people may have to very, very rarely plug in their vehicle. And, I don't know if he understands that it's got a battery. And so if you drive an average of 30 miles a day, if that is truly your average and you don't go beyond the amount of miles that your battery can do, like let's say you go on a 150-mile trip at some point, you can tank that up on the days when you drive less than 30 miles a day. So it does average out. This is marketing speak. So most Aptera owners will never have to plug in their vehicle. It's probably true for most. The majority, I would say, like 90% of Aptera owners will never plug in. No, that's definitely not true. But yeah, you will have to very, very rarely plug in this vehicle for most people. And that's a big selling point. And he's kind of hitting a straw man, I guess.
Warren is absolutely correct in this, and the fanboys are so thick they can't understand why. And they just try to fumble around trying to justify that this misleading statement is not misleading. It is misleading. Warren is 100% correct. Now, I gave somebody on Warren's comment section an example of how a person can average 40 miles a day and still have to, once a fortnight, make a long enough trip that they need to charge. It's that simple. 40 miles a day, yet once a fortnight, making a longer trip. It can work for 30 miles a day as well. And what that shows is that most Aptera owners are more than likely having to charge at least fortnightly if they do what I did in the example. But it doesn't matter if it's not fortnightly, monthly, or maybe every second month. If they do it every second month, that's 6 times a year they need to charge.
Because of clouds, because of the angle of the solar cells. There's a variety of reasons. And because of the amount of solar cells you're going to be able to fit on the car, it's probably going to generate enough electricity to run the air conditioning.
No, see, this guy totally doesn't understand at all. I mean, it's far more than that. He's thinking of these small solar panels they used to put on Priuses and like Hyundai Sonatas and stuff. No, the car is very efficient and it has a lot of solar panels. It's not going to be enough just doing the AC. It's not that.
Well, they have had 5 prototypes and not one of them has shown that it can power the car to go, as far as I say, an inch on solar. I have not seen evidence that solar panels on a prototype power the thing for an inch, and they should have been long past theory. Their computational fluid dynamics is snake oil. It's theory. It's never proven. And they've had the prototypes and never proven that they can go anywhere on the solar. I'd like to also add that when they took the Gamma out to St. Moritz in Switzerland, they had a couple of months of solar and only were seen to have driven in a car park once and then at St. Moritz for a day on an icy little lake and in the car park. And for those little drives and all of those weeks and weeks of it sitting in the sun, that night they had to put it on a charger. It was seen, if you look at the relevant videos, it was seen being charged. Now, how on earth does a 400-mile vehicle that's only been driven in car parks for a short time and had weeks and weeks in the solar, why on earth would it need to be charged up at all? There's something fishy going on.
Once you're running the air conditioning or the heating, you're not going to have much left to drive the car. It's a nice, idea. Really, really unclear how much electricity this will actually generate on a daily basis.
It's very clear. They've tested it.
But this bit right here, this is a
It's not very clear. They haven't tested it. They've done simulations on computers. Show me the tests.
Representation. Most Aptera owners will never have to plug their vehicle into charge.
Yeah, I mean, I'm going to agree with him. It's to say that they never have to plug in their vehicle ever. It's probably not the most accurate statement. If they would have said most Aptera owners will have to rarely plug in their vehicle, that's a much more defensible statement.
So now the cretin has finally woken up to the fact that Warren was right. He disagreed, tried to justify it, and now the lights come on and he says, I'll have to agree with him. There it is, done and dusted.
So next we're going to dive into their circular. This is Aptera's, when you go to invest, this is the document you can download. You can see that the circular is dated December 9, 2022. It's not updated for end of 2022 numbers, right? We're now in March of 2023, and they haven't updated to show what their financial status is. This is something that I would say is troubling. If I'm an investor and you're going to try to sell me on an investment, I want current numbers. There's no reason that by late March of 2023, you can't provide your investors with what happened through the year 2022. So that's a troubling little detail. But this is just to give you an idea, what they're trying to do. They're trying to raise at $10 a share. They're trying to raise a total maximum of $41 million. So that's 4.1 million shares. Emerging growth company may take advantage of certain reduced reporting requirements as relieved of certain other significant requirements. So they're reporting less detail about their company than other companies you might invest in. I just find that now, I understand from an accounting perspective, it's less cost, but it doesn't cost that much. Now, this is probably the biggest deal of all. There's a whole lot of deals, but our auditor has issued a going concern opinion. Our company lacks significant working capital and has only recently commenced operations. We will incur significant additional costs before significant revenue is achieved. These matters raise substantial doubt about the company's ability to continue as a going concern, and our existing cash resources are not sufficient to meet our anticipated needs over the next 12 months from the date hereof. They intend to operate with funds received from Regulation A offering and future proposed campaign, additional debt equity financing. There's no assurances that management will be able to raise capital on terms acceptable to the company. We are unable to retain sufficient amounts of capital, may be required to reduce the scope of our development, which could harm our business. This is a company that could fail if they don't raise more money. And
That's absolutely true for every startup. So, I mean, every startup is going to have this thing. Every startup fails because they can't raise money. That's the main reason that startups fail. Not necessarily because their product is bad, but because they can't raise capital. And that's true for pretty much every startup.
The cretin is agreeing again. Now, I thought that if you're going to disagree with a person, it has to take disagreement. And so far, on two main points, he has agreed wholeheartedly. Took him a while to realise why he needed to agree on the first one, but now he's definite about this one. He agrees that they could fail by not raising enough money fast enough.
In an environment right now where we've got potential bank runs, we've got the Fed might be raising rates. If you watch the All-In pod, they talk about how when rates go higher, people are less likely to invest in startups. It's a real challenge for them to raise the money they need to go forward.
So he's not wrong. So we know about it. We've talked about it on our channel multiple times. The capital markets are not doing well. It's very difficult to raise capital. And so that is a substantial problem. But Aptera has a very compelling product and a very compelling story. And even in bad markets, compelling products and compelling stories do win out.
So now we get him agreeing for a third time. When it comes to the current environment, he agrees that it's not a safe time to start up a company. But he now puts the focus of attention on the quality of the product. If anybody watches my suite of videos, you will see that there's lots to doubt about the quality of the product. The product is unproven. It has wildly optimistic snake oil type claims when it comes to performance, and yet none of them, after 5 fake prototypes, they have yet to prove any of the claims. They've stayed away from wind tunnels, so you don't get a true drag coefficient number. They've stayed away from drag strips with timing lights on so that you don't know what the acceleration times are. They've stayed away from just simple scales. So they build a prototype and won't tell you what it weighs, at least not within 100 pounds, whereas they should be giving accurate weights for these products.
They, when in good markets, even bad ideas get funded because there's more capital than there is companies to invest in. Now there's more companies than there is capital to invest in, but the best companies will still get investment. And you can see that Aptera's fundraising campaign, the Accelerator campaign, has actually given them quite a bit of runway.
And even that's not even getting into whether they can actually succeed in their business plan, which is a whole nother problem that I think is a huge problem. But you can just see they're telling you that their auditor has said this company may not survive. That's a pretty risky investment. There's always this question.
So I'm probably going to stop this video here because the guy has not listened to any presentation from Steve and Chris. He fundamentally does not understand the product, doesn't understand how solar charging works, doesn't understand the efficiency metrics and the efficiency breakthroughs that Aptera has made with aerodynamics, with different types of manufacturing. He doesn't understand that Sandy Munro has looked at it and has invested personally himself and thinks it's like a game-changing vehicle. He hasn't looked into anything, and he's basically talking about things that are true for all startups. All startups will fail if they do not raise funding. All startups require investments to continue forward. All startups do not generate revenue initially. And all startups are very risky. And so if you look at any startup and you say that it'll likely fail, you're probably right. We've talked about this before. Most startups do fail. However, Aptera is a very compelling project, has a good product, a good idea. Lots of people are interested in it. If any company is going to succeed in this bad capital environment, Aptera should be one of them. And I think that someone who doesn't understand the product, which Mr. Redlich obviously does not understand it and has not researched it well, he obviously has not watched a single presentation by any of the founders, and does not fundamentally understand how Aptera as a vehicle works and how the company works and how they plan on manufacturing and how their manufacturing is much leaner and does not require as much capital as other companies. He's just looking at it as a startup like any other, and he thinks, well, there's so many startups, it's hard to raise money, it's going to fail. And if you go from that perspective, then I can see where he came to that conclusion.
That's a lot of ranting just to go and say for the fourth time that he agrees with Warren. So, will it fail? Yes. Basically, he agrees with Warren, but he rants. And his main point is that Warren hasn't looked at the viability of the product. Not at all. He doesn't need to. Just from financials that he's looked at, he doesn't need to look at the viability of the product. It will fail on financials alone. But I have looked at the viability of the product, and I have made probably 24 videos about the product itself. Not the financials so much, but the product itself. And I say the cretin is lying when he says it does all these things. And I say that because none of those things that he says it does has ever been proven. He says it does it because the snake oil salesmen say that they've run a computer and they're the numbers they get out of the computer. They've built 5 fake prototypes and proven none of the numbers. None of them. When they took one down a drag strip, they took the timing lights out, switched them off. First time I've ever seen that in my life, they did it. When they quote a coefficient of drag, they never take one near a wind tunnel. When they quote a top speed, they only drive it in car parks and around the block where they can't do any top speed. When they quote acceleration times, they don't prove the acceleration times. There is nothing substantiated about this product. And the biggest thing of all is that this strange vehicle that has no radiator is not going to cool. All vehicles have radiators to cool them. unless they're old-fashioned air-cooled Beetles and other vehicles that have fins on the motors to get the air cooling. This encloses the motors and the batteries so much so that they aren't finned and they can't get proper air cooling. So they're ready to boil, they're ready to overheat. And that's what happened to the first Aptera. And they used this excuse that they lacked funds. But the first Aptera didn't work. And for the most case, as soon as they folded, they destroyed the Apteras so that nobody would know they didn't work. When this one folds again, I don't want to see any of these fake prototypes destroyed. I want them properly tested to see how close they came to those computational fluid dynamics figures.
Okay, so I watched the rest of this video. I skimmed through it. The bulk of it is him going through the SEC filing and nitpicking various things. And if you want to look at the filings, when they say it, they talk about all their risks and their problems because they're trying to be very transparent up to their investors. And if you look at it a glass half empty kind of perspective, then yes, you're going to come out with a very negative. You can come out with a very negative perspective on the thing, and I think that's exactly what he's doing. Then he goes into a little bit about whether he thinks there's much of a market for it. And then he says, I don't know how much they need to sell to become profitable. If he'd watched the previous investor webinars, he would know that they were profitable after about 20,000 units, which is easily doable. So it's not like they need to sell that many of these vehicles. It is going to be a niche vehicle. It's not going to be a mass market vehicle. If they sell $20,000 to $30,000 units a year, which I think is easily doable. There's far more demand than that for that. They will become a profitable company. So he just fundamentally has a misunderstanding of the market, the vehicle, the technology, and then just reading the SEC filing in the most negative light possible. And then you'll come to this perspective. And most of the problems, quote, problems he has with the SEC filing are problems that are universal, again, to all startups.
Well, that was another long rant. And I'm going to go back to Warren's original video because I believe that the cretin has left so many points out that are things that he couldn't deny. He's agreed to most everything on what he's brought in, but there are things he couldn't deny. And it was a while ago that I watched Warren's video, but there was something that really stood out that I believe the cretin has deliberately omitted. And it had to do with the fact that these founders got shares at something like 1,000th of a cent, and now they're selling shares at $10.50 each. And when they go belly up, they'll be first in to get their money back, while the ones that are languishing behind will get nothing. The ones that paid high prices for the shares will get nothing back, but their thousandths of a cent might have been hundreds, I don't know, I'm going to check it out. But their small shares will become big money when they pull it out just before they fold and the money's divvied up. They are going to make the money that way, and they didn't put it in.
It's not specific to Aptera. All startups don't generate revenue. All startups are risky. All startups have a lot of uncertainty. All startups don't have a product in production, and that's just the way that it works. Okay.
Especially Chris Anthony and Steve Fambro. There's no employment agreement with any of the aforementioned executives. Is that normal that there's no employment agreement with the executives? I'm not sure that that's normal. There's no guarantee that the executives will agree to terms and execute employment agreements that are favorable to the company. Should any of them discontinue working for the company, there's no assurance the company will continue. Now, I think they own a lot of shares. I think we'll come to that later. They own a lot of stock in the company, so it's going to be hard for them to walk away. But there's a concern right there that they're not, and even if they had a contract, they could walk away. So, and then just another detail: our officers control the company. We currently have no independent directors. Now, at this early stage, I don't think it's shocking they don't have independent directors. Executive officers and directors are currently also our controlling shareholders, holders of 55% of the outstanding Class A common stock. By the way, the stock that you'd be buying if you buy into this company is non-voting stock. As I understand it, it's non-voting stock. And it says right here, our executive officers and directors may be subject to potential conflicts of interest. I think there's some indication somewhere in the documents that there have been some transactions where there was a transaction with a business that was owned by an officer or director of the company. There's preferred stock with rights superior to those of the common stock in this offering, including a liquidation preference. So if the company goes poorly and there's some assets left over, not that this matters a whole lot, but if there's some assets left to be distributed, you're not getting them.
This is what I was talking about. It wasn't that they were paying a thousandth of a cent, but that they were paying 1 cent as opposed to investors paying $10.50, which is more than 1,000 times the cost to investors.
The preferred shareholders are getting them. Bondholders are getting them first. I suspect that Class A and Class B shareholders are treated the same when it comes to liquidation. But if it goes to zero, or let's say it goes from whatever value it is, it drops down to 1/10 of the value. You're probably not even getting your 1/10. You're probably getting nothing. So you have to ask yourself the question when you're doing an investment like this: what's the upside and what's the downside? Well, the downside is zero, and there's a significant risk of zero. Now, do they sell anybody anywhere and what the upside is investing in this company? I haven't really seen a strong case for the upside. That's one of the problems. So this is the risk of immediate dilution. So you're buying when you buy shares in the company, you're buying a percentage of ownership in the company, but there's all these things that are going on. Company typically sells its shares to its founders and early employees at very low cash cost because they're in effect putting their sweat equity into the company. When the company seeks cash investments from outside investors, the new investors typically a much larger sum for the shares. So you're paying more for your shares than they paid for their shares. By the way, you're paying $10 a share. They paid a penny a share. But this demonstrates the price that new investors are paying for their shares with the effective cash price paid by the existing shareholders. The method gives investors a better picture of what they will pay for their investment compared to the company's insiders. And you can see the price per share, $10.50 a share. I'm not claiming I understand this part. I'm not claiming I understand the table, but you're being diluted. The people who bought early paid a penny a share. You paid $1. You're paying $10 a share. Yeah, you can see it right here. Since inception and prior to the commencement of this offering, the officers, directors, and affiliated persons of the company have paid an aggregate average price of 0.01 per share, 1 penny a share of common stock, comparison to the offering price of $10.50 a share. You're paying 1,000 times as much for your shares in the company as to what the founders paid. That's a pretty big gap. That's I thought when I saw Gary Black's offering, I thought it was tilted. When I saw Boxable's offering, I thought it was tilted. Boxable's offering, you paid 33% of the capital into the company and you got 2% of the company. This is starkly worse. This is a really, really bad deal. You're not getting much for your money compared to what the founders got.